Hello and welcome. I'm Patrick Curtis, your host and chief monkey, and this is the Wall Street Oasis podcast. Join me as I talk to some of the community's most successful and inspirational members to gain valuable insight into different career paths and life in general. Let's get to it. In this episode, Jaimi Goodfriend, head of Point72's investment professional development and director of the Point72 Academy, shares her winding path through Wall Street. From starting in M&A when she graduated from Michigan in 1997 to her jump to equity research a few years later, we learned the main reason she decided to pursue a career in finance and how she eventually ended up as a hedge fund analyst working for some of the most successful funds in the world, including Balyasny and Citadel. Find out why after 3 years on the buy side, she decided to take a massive pay cut and give it all up to become a professor at the University of Illinois, and what drew her to Point72. Finally, in the last part of the pod, we discuss the Point72 Academy, what they look for in undergraduate hires and young professionals, the future of the industry, as well as the odds of actually breaking in. Enjoy. All right, Jaimi, thanks so much for joining the Wall Street Oasis podcast.
Thanks for having me. Happy to be here.
It'd be great if you could just give the listeners a short summary of your bio.
Sure. I graduated from university, I guess at this point, kind of a long time ago, and started my career in investment banking and mergers and acquisitions and moved to the sell side research a couple of years later. And then I kind of found over time I was looking to do what my clients were doing on the buy side. So I hopped over to the buy side and covered industrial stocks at a couple of multi-manager hedge funds for a few years. Ultimately, though, I always found that for me, my passion was truly in teaching. And so in 2007, I left the hedge fund space to become a university professor where I taught for 7 years and developed some programs for a couple of different universities. It was that time I figured out, program management and figuring out that talent truly can be recruited for Wall Street anywhere led me to Point72, where I developed Point72 Academy.
Very cool. So a lot to unpack. It's actually a very interesting background, and I think the listeners will find some of your transitions and decisions hopefully enlightening. So let's start all the way back at undergrad, though. I know you said it's a long time ago, similar to when I went to school, but so you don't have any grades. I have all the grades to prove it, but tell me a little bit about.
Color it.
Fair. Tell me a little bit about just when you're at Michigan. Was there like, oh, I know I want to be in finance, or was it something that you kind of stumbled into? And you said you did M&A right out of school, so just what kind of attracted you to that?
I think that's a really important point, is that I didn't know it was what I wanted to do. I actually thought that I wanted to work with people. I stumbled through a few different concentrations in the liberal arts side of the University of Michigan. I did not go to business school. And I found, for financial reasons, a sudden urge to make money. And I think it was that driver that led me to finance in the first place, which I think it's super important to talk about, because, if you're in this business to make money, it's probably not the right reason to be in the business, which is ultimately why I left. But I can tell you that, with certainty, it was really for financial reasons. I realized that I wanted to be in a position where I could afford to support, myself and my future family.
Were you kind of leaning on your parents? I know for me, I was a similar thing where I was like, I don't want my parents to have to pay any more tuition or like do anything. So I was like, I need to go do what makes decent money. And everyone's like, go to banking. I'm like, what's banking? Was that similar kind of your thought process? And then you just kind of started going, like, when did that happen? Junior year, sophomore? Do you remember?
Well, that's exactly right. I think that it was in my junior year when I kind of hit that panic button and look, back then there was no internship where you could learn this stuff, right? So I quickly just figured out what could make money for a living without really understanding what I was getting into. And I think that was an important driver for me to learn more about how to educate the future investors in the world, was because I felt like there was a lot of information I was supposed to learn on my own. And it was very difficult for me to figure out, what it was. So what was banking? What was investing? And, I think that it would have been really helpful for me to have better education around that before I jumped right into it.
But when you were kind of by junior year, you had that panic button, who told you even about investment banking? How did you even stumble on it?
I accidentally found it in our career office back then. If you can picture back then, instead of having internet links to apply to, really dating myself and perhaps you too, you had these manila envelopes that you literally dropped your resume into, and you could just, submit them without a lot of extra cover letter work. And I just, I had a fairly well-rounded education in undergrad because I wanted to just learn how to think. And it was really my concentration in that led me to decide, if I could try to find through employers and through descriptions of companies and what they did, a role that would help me continue to learn.
Do you remember
and I think that was where.
Sorry, do you remember anything about the interview process back then? Like, was it really rigorous, or was it more like fit-based stuff?
Yeah, I remember. So I didn't go to business school. And so certainly back then, the interview processes for liberal arts majors at investment banks and consulting firms and whatnot were a little bit more on the critical thinking side and problem solving side than they were on the technical side, because that would have just been us staring at each other for 30 minutes. And actually that happened. I'm happy to talk about this. That happened one day to me for sure. And that's a lesson I never forgot and try to pass on to my students now.
Happened to me at a Goldman interview. Same thing. They were like, they didn't care that it was, I've been told you're not going to be asked any technical questions. You're a liberal arts man. I said, okay. They get in there and they're like, walk me through a DCF. And I'm like, it was
that
bad.
happened to, yeah. Like, I mean, the most embarrassing stories I have are about all the times I screwed up interview questions where people kind of said, could you repeat that answer? Just because it's like they wanted to share it with their friends later because they said, you can't believe what I just heard in terms of interview answers. And I was deathly afraid it was going to show up on the internet as like a what not to do. Essentially on your website.
We didn't exist then.
Right.
Yet. But,
thankfully.
So tell me a little bit about just, so you dropped your resume, you started doing the interviews, and then was it just serendipitous, like, late 90s, it's like, why not internet? Why not, go move to Silicon Valley like a lot of people?
It was just before that, to be honest with you. And I did choose, so I started in 1997, and the internet, it was just starting when, and I actually did M&A in San Francisco. So I did have the experience of meeting people who I'm in touch with today, who are still out there in Silicon Valley. And for me, that wasn't, the driver of my next job was actually more geographical than it was to stay out there. So I found the startup community to be incredibly interesting, and I love the entrepreneurial spirit of it. And I found myself coming back to it later in my life, but that wasn't the right time.
Got it. Okay, so tell me a little bit about what it was like M&A back in the late 90s. Was it the 100-hour weeks like a lot of the kids are? I mean, work from home has been really, really hard for the analysts. A lot of them are dropping like flies after 6 months, just saying, this is brutal. Tell me, was it similar back then?
Yeah, I think that, you're raising a really important point in that culture and community has to persist more than ever now. And I think what allowed me to sort of suffer through that period of time, cranking through the models and the pitch books. And then, back then, if anyone who needs to Google this, what a fax machine is, I had to fax my drafts to my vice president at midnight on a Saturday night. And that was completely normal. Like, the whole world should be doing this with a college degree. But it was true. It was like that then. And I think what sustained me was the community that I felt in the class. And I have got to imagine that the absence of that now is material.
Oh yeah, it's bad. What we're seeing is really bad out there in terms of people. Like, we even had an MD post like, how can we do better? And everyone there's plenty to say from the community. So, okay, so you're there for a couple of years. You're working really hard. Sounds like super long hours. This is in San Francisco, correct? You said?
Yep.
And so then you're making, why make a transition to equity research? Was it lifestyle decision? Was it, what kind of drove you to go there? Because I think a lot of people think you're in banking, you're in M&A, you're in the most like, high profile, you worried about the deals you do, that type of stuff. Why move to equity research, which is like, often considered a cost center?
I felt incredibly lucky to be chosen for the M&A group at my firm. And I wanted to pursue M&A despite my lack of training and background, because it felt to me to be the most rigorous. And I thought, for the time invested, for the 100 hours a week or what have you invested, I wanted to maximize how much I could soak up of this industry. And I paid for it, sure. But to me, that the return was worth it because I was learning skills for the first time instead of just, critical thinking frameworks. And when I think about banking in general and the role and the function of an investment bank, which is really the in-between conduit between companies and those who want to invest in capital in those companies, and really the reallocation of capital, it's very transaction oriented, and the firms are transaction oriented. So the roles for the junior talent, I find, are obviously transaction oriented as well. And for me, I wanted an ongoing relationship with the companies that I was covering and following. I wanted to study the businesses more, and I wanted my activities day to day to be around the narratives of the companies, how they changed, how the market changed. And I don't think there's as much of that in banking. And for me, I was much more interested and engaged in that practice.
You had that much introspection at 24 years old to know, like, this will make me happier or whatnot, or it really wasn't getting burned out? For me, it was like I was burnt out after a couple of years. I jumped to private equity because I was like, I can't do another year. I literally physically couldn't do another year. So I guess my question is, like, when you were making that decision in that maybe probably the second year you were doing M&A, was it really like, why not go to the buy side then? Did you not know about hedge funds? Why not go to do that stuff? Why equity research first?
Well, that's interesting you say that.
Yeah, I'm trying to unpack that because, like, it's not a usual thing we see now.
Well, I think that's the key point. Is now I think it's much more difficult, or it's much easier, to jump to the buy side from investment banking. Back then, I think it was more difficult to get to the buy side directly, particularly as somebody directly from undergraduate, without a longer route beforehand. Most people that I knew had to go back to school, for example, even to get to the sell side. And the private equity point you raised, I think, is interesting. Burning out, doing a lot of transaction work. I don't know. I don't know if you found that to be changing that much on the private equity side, but for me, I kind of thought that would be more of the same. It's just a question of having a more critical eye on the transactions because you're the buyer and not the seller. I don't know if that's true.
The hours were significantly less for me, but I know it can be considered banking 2.0 for many. So, like, for me, went from about an average of 90-ish hours a week down to about 55, 60. So it was a pretty dramatic lifestyle improvement. So yeah. Was that a consideration at all, like, when in the second year?
Oh, yeah. I mean, absolutely. It's like, let's be honest with each other. When I'm giving you the adult answer reflecting back 25 years, I've summarized and digested, the incredible amount of stress and burnout that occurred during that time. And I can still think back to those days, late at night when I was, sitting, trying to work and iterate on the same thing over and over again. For me, by the way, the other issue was that I wanted to move back to be closer to my family in the Midwest at that point.
Got it.
So I applied actually to a private equity job and to a sell side job in Chicago, which is where I'm from. And, had made the commitment to myself, at least, that I was going to move back there, with the first job I could find that was a good opportunity.
Was it a pay cut going from M&A to?
No.
No? Okay. Great.
No.
So you're there for a good run. You're doing equity research for a while, and you kind of then eventually get into the hedge fund world.
Yep.
So tell me about how that works, because I think it's a little more common. Like, were you getting your CFA then? What was the thought process of, was the buy side still you had applied for a private equity position, you said. Was that always kind of on the horizon, like private equity markets?
Yeah, I think for me, I was still learning what the landscape looked like. I would say I didn't really know back then what a hedge fund was at all. It was a very different time. Decades ago, there weren't as many. And so I had looked at, what are firms where I felt like they were longstanding firms and I could learn. I think the theme here is, where could I learn more? Because I was young and I knew I didn't really know anything, certainly coming out of a liberal arts, program. And I felt like I was processing a lot and not learning as much as I wanted to. In some cases too, and that was a little frustrating for the amount of hours I was putting in, especially in the second year of banking. And I imagine that resonates with, some of this audience too.
Yeah, for sure. Yeah. So did equity research, was it a similar thing where you started feeling like the learning curve flattened out a little bit?
So a couple of things happened. When I got there, I was covering private prisons and garbage companies, which is, I'm sure, what everybody's dream was during the tech bubble. The reason I got the job, I think, was because nobody else wanted to do it. And for me, I found that to be an opportunity where, as I alluded to before, actually, the pay was pretty good, probably because nobody wanted to do it. And so they kind of had to get somebody who would be willing to learn the industry. And I did learn for 3.5 years. I was there covering more companies, picking up water filtration, which actually was really interesting for me. And then getting my CFA and going to school actually at night part-time to get my MBA. So I had no life whatsoever because the extra hours that I was not spending at work, I was now spending, in school or studying for the CFA exam.
So you were doing an MBA in the evenings on top of
eventually.
So was Kellogg, was the evening program like a normal thing back then?
Yeah, the evening program was an alternative to the day program. And when I decided, there was a pivotal point in my sell side career where I think, you're absolutely right. I think I kind of learned what I wanted to and just realized I really longed to be the client who had the accountability. Mm-hmm. With the sell side and with banking, what I had found combined is that there are a lot of activities where you're not accountable, you're part of a team, and that's okay. But for me, I really hungered for that report card and sort of that tell on what I was doing and how I could get better. I think the industry certainly teaches all of us a little humility, no matter what we do. But I was trying to think about ways where I could get to that buy-side job. And so I knew my current firm wasn't going to be the right springboard for it, and I didn't want to put them in that position. So what I did is I applied for a transfer into a full-time program at Kellogg for the second year.
Okay.
And I was admitted to that. And they admitted 8 people that year to do it out of all the applicant pool. And I was lucky enough to get that seat.
So you started part-time and then you eventually moved to the full-time program. And your time there, was that helpful to kind of get a better, I mean, it sounds like by that point you kind of had an idea of buy side is where you want to go. So what was it like, just the recruiting out of there for, like, I know nowadays hedge funds probably just laugh if you're getting an MBA. They're like, what are you doing? Like, you don't need that. The CFA probably less so, but was it similar to, like, why are you getting the MBA? Did you have that any sort of pushback on it, or?
A totally different time. I mean, back then, that was almost 20 years ago. And so I think that the MBA at this point has a different, I don't want to say reputation, but it's not, it doesn't have the same transitional sort of, easiness to it. And people never questioned why I had gone back for the 1 year. The opportunity of the job market at that time out of, MBAs was pretty small, particularly where I went to school at Northwestern, which is really known for more strategy and marketing and what have you. And so I found myself sneaking into other schools, neighborhood schools, and then don't get me in trouble for this, but like if I wanted to learn what some of these other larger buy-side firms were doing, I might have had to sneak into a different meeting at a different school to learn, and I was going to do it because that's what I knew that was what I wanted to do.
Are you suggesting you were in booth? You were sneaking into booth sessions? Or?
I would never. I know.
Your Kellogg people are going to be very angry. Not just kidding. It's normal. We've heard that before.
Cut that part out. Well, the truth is, I did get the offer through Kellogg, and when I was hired at Balyasny, it was they actually had come to Kellogg, and so I did it the right way in the end. And I do recruit today from both schools, just to be fully fair to both.
And as you're kind of that whole process, was it similar to what it is today, where it was a long short type, equities position, analyst position, where you were expected to come into the interview and have a stock pitch ready, long, a few long ideas, a few short ideas, or was it totally different back then?
That's exactly how it was back then. I had prepared several pitches. I was questioned on technical skills. I had a lot of what you call fit, interviews. But I always found, and I think what I like the most about when I compare, the buy side to private equity or investment banking, hedge funds have one goal, and that's to make money. And, your performance is your meritocracy. And I felt that the interview process was kind of the same way, which I really appreciated. The feedback was pretty quick. And, what they wanted to test was just whether you had aptitude. And we can speak to that in Point72 Academy because, I recruit obviously for that. But lessons learned from that was, I really appreciated the straightforward nature of that recruiting process. It was just like, how good are you at idea generation?
Idea generation. So was it testing you at all back then on like mental math and doing it at that type of
I
stuff?
never received a mental math test. I know many people who did, and I have views on this for the poor souls who get that
Do you
who
like it
panic.
or do you not like it?
I've met many smart people who can't do it. Um, and I have, worked with many people at firms who swear it's the only thing that matters. I enjoy it. I actually think you can learn it. I think there are some good resources out there that can teach you how to do some of it. But there's probably some degree of talent out, that you would need to do it really well.
So you're graduating from Kellogg, you're starting your hedge fund career, and
Mm-hmm.
are you put in a specific group? I see here basic materials. Is that like you were assigned it and you just had to learn everything about it? And what was that like?
Yeah, so I basically started where I left off on the sell side with business service. I'll just call it business services, so a slightly wider mandate than the 18 companies I covered on the sell side. And there just wasn't a lot of alpha, or return, absolute return or idiosyncratic return in those names, the way that there was in other spaces. And so I remember, Dimitri, I worked directly for Dimitri Balyasny, and I remember he took me in his office one day and said, this China thing seems kind of interesting. Why don't you go figure that out? And I was like, what does that mean? And I found myself getting on airplanes with translators myself and going to Asia and, trying to figure out what supply demand looked like for metals and mining. And before I knew it, I had picked up that space kind of out of I more lucky than good, I think is what the quote would be. But if you research back in time in the early to mid 2000s, what a time it was in that market with the Asia super cycle. And so that really is where my success began with basic material coverage.
So is that something like you're trying to predict basically commodity prices and stuff like that? Or what types of trades would you suggest to the firm? Like what types of idea generation were you doing? Was it all like, was it on the credit side, equity side, always equity? Like what were you doing day to day?
I've always been an equity analyst. So, and this is not too dissimilar from how I think about training people at Point72 Academy. I think you have to be really deep in your industry first and just make sure people have proper context. When people deliver a pitch, you always want to make sure that you can tie it to the proper context, right? And the numbers have to tie to a narrative. And so I was always providing single stock idea generation, but it was always with the context of having the industry expertise or trying to get to expertise.
So they were literally flying
So
you to China to try and do what? Like what is that going to actually do? So you could talk to like senior leadership there at different firms and try to figure out like what's legitimate and what's not?
I think that's important for the whole hedge fund industry in general is, at a very young age, you're given a lot of responsibility, including a lot of, executive meetings. And that's part of it. But it's also being able to do the fundamental grassroots research to understand supply and demand dynamics because commodity prices trade on the US dollar, all around the world. But supply and demand, in any commodity, I think you would want to think about marginal consumption and marginal demand dollars. And so, or the dollars come from marginal demand. And at the time, the marginal demand was coming from Asia as they were really pushing that demand curve. If you can picture the demand curve on
Totally get it.
right.
Totally get it. But why are you getting on a plane? How is that going to help you figure it out?
I think
that's what just surprises me. It's just like having you on the ground with the translator. Who are they trying to, if you can share, who are they trying to get you in front of to get more information? It's obviously to get information, right? So to try and figure out if you're
without giving away too much from the firm's perspective, I think you learn more by experiencing and seeing for yourself just like what that inventory is. What does it mean when you have piles? I'll give you another example. You have piles of container board, the boxes we all receive from Amazon. Do we actually know what a pile of inventory looks like or means or feels or how dusty it is sitting there waiting to be sold until you actually go? The answer is you have to go. And so, I think that's where resourcing can become very important.
I worked on a paper and packaging restructuring when I was at Rothschild for 2 years. So I was in Mexico and I know very well what it looks like, but not by choice. So you're there for a year and a half Tell me why the transition. So
Well,
it was to Citadel, right? It was, year and a half
yeah,
in. Was it,
about 2 years.
yeah, about 2 years. So tell me, was it something where the names you were working on, there wasn't a lot of alpha initially, but it sounds like there were. It sounds like you were having success um, once they put you on the basic materials. So why move?
Right. Well, I think the opportunity presented itself. So at the time, Citadel was opening up or reopening up the Chicago office and restarting global equities, and they were looking to rebuild from the bottom up. And so to have that opportunity to help, the industrials book, and at the time it was sort of a single manager structure in global equities where there was only one PM per sector, and so to really see beyond that team, I think was a good transition point for me to grow my coverage, which is something a lot of analysts really, strive to do as they continue to develop, and to gain more responsibility and to learn, from a great firm. And it's not to say that I didn't appreciate what I had at Balyasny. I think, I actually really enjoyed the continued relationships I still have with that firm today. But I think it was a great opportunity for me to grow further as an analyst.
Was it regional at all? So were you in New York, or where were you with Balyasny for?
I was in Chicago for both firms.
You were still in Chicago, so it wasn't anything about region or anything like that. It was more just getting more coverage. Maybe the name Citadel, maybe the pay was better. Was pay? I know for hedge funds it's all over the place, but I assume base is relatively decent. But then the bonus can be so crazy, wild fluctuation. It can be zero if things go really poorly, or it can
That's
be
pretty wild.
yeah, or it can be obviously several 100% above more than your salary. So were you experiencing those types of paydays? Like, I mean, because '03, I'm looking when you were there, '03 to '06, I think were pretty good years, right?
They were, and I think that speaks to the meritocracy that I talked about before. If you're at a firm where you have promotional tracks, I think that can also lead to things like caps, no matter what. And I think that's a little bit of code for that. And for me, particularly back then at Citadel and at Balyasny, there were no titles. And at Point72, by the way, we don't believe in titles either, sort of for the same reason. You should really get to experience reward with the team if you do well. And so, I think that's my really roundabout way of answering your question.
Fair. Okay. So, and then you were at Citadel for a year. And so tell me a little bit about the following transition, and then we'll kind of get into more of your teaching career and that final transition. But so you were in hedge fund tradings for 3.5 years. So like that final transition out of Citadel, was it something similar where it was just a great opportunity to be a PM?
For me, that was sort of the moment where I realized I could sort of take the risk that I wanted to transition my career out. And at that point, this goes back to the discussion we had earlier about, why do you do what you do? And, what drives your career, what drives your happiness, what motivates you. And for me, I think the first 10 years in total, what that was about money. And if I'm just honest, at that point, I thought I had made a little bit of money, sure. Or some people might say, more than a little, but like it wasn't making me happy. Yeah. And so, look, these jobs are really hard. They are still a lot of hours. I didn't get to experience the 60-hour work weeks that you're describing, to be honest with you, even on the buy side, because I think I'm the kind of person that just runs and runs and runs until and sort of I'm never satisfied with my outcome and always want to pursue the next thing, which I think made me a good analyst, but it also made me, probably have a limited duration. And so after 10 years, I started to think about what I wanted to do with my life. And that's when I turned to teaching, because I knew even on my first day of banking, I remember walking into the sunset with this guy who is still a good friend of mine. And we were walking in and I just literally blurted out loud. And I can't believe I'm saying this on a podcast, but I'm just being honest. Like, oh my God, I just wasted a day of my life. And you probably shouldn't say that on your first day of banking, although I bet I'm not the only one to ever say this on the first day of banking. And he said, me too. And I don't want to say his name because I'll tell you, he's still in the industry. And I said, in 10 years, I'm going to be a professor. And he said, me too. And 10 years later, I was a professor. or
And
what we would call
he's
a
still in the
lecturer.
industry, yeah.
And he is, I think, yeah,
Well,
and
it's
then,
tough. It's tough. You're putting millions away, by, if you're in the industry for 10 years, you're at top hedge funds and you're a great analyst, you're easily clearing, you can probably save several $1 million easily in the bank. So, after tax. So, you're feeling like, okay, I don't have to chase the money anymore, but it's also hard just to let go of that. That paycheck every day and just say, okay, now I'm going to be a teacher and go and like take up 80% pay cut or whatever it is, 90% pay cut, or, so
yeah,
like
keep going.
98% pay cut. So it's a,
Yeah.
it's a pretty dramatic move.
I'm not the only one who's done it though. And I know there are a lot of people who say, I'm going to go, I just had this example last week with somebody who said, I want to go to med school, but I got to pay for it first. And so I want to go into banking and pay for it. And I think it's a little more common than you think. And I think what's common about that is that the people who do it for the money, it's not the reason to be here, right? It's not the reason to be an investor. You should be an investor because you obsess about businesses and companies. And I have some of that, but I had more of this other thing. And, I'm going to work hard no matter what I do. But for me, it wasn't going to be about being in the model for 90 hours a week. It was going to be about developing people.
So you're kind of coming out, it looks like you left your final hedge fund job around 07. Then we had the fun, great financial crisis. And you started kind of right at DePaul, kind of right after the major crash. So is that accurate?
Yeah, I started actually at the University of Illinois in 08 in the crash.
In the crash,
I wrote my first class in an hour, to be honest with you. Like I knew exactly by the time I had done this, like I was ready. I knew exactly what, I'd gone through a finance concentration at Kellogg. I had gone through the CFA process at that point. And I knew, I'd gone through banking training. So I think I understood at that point what I was going to get from formal education. And it also helped me understand what thought I needed that was missing. And so I just sat down with a blank sheet of paper and said, if I had 10 weeks to teach somebody in 40 hours, this is what I would do. And I laid it out. It took me an hour. It was very clear to me. And I started pitching it to schools.
But what was that? What was that course
called? It was
called?
a hedge. It was actually called, I forget the final name we called it, but I think it was like Intro to Hedge Funds. Where basically I was trying to explain if I was going to be a fundamental investor. But I think there's a big gap between what's taught in school, and I understand why to some degree, and what's needed to be successful in the job. And it's monetization. That's not something I think that's easily taught in academia, and that's a fair point. So it became a practitioner course on sort of closing that gap to help people become prepared for the real world. And so I launched it in 2008. I was paid, to your point, not a lot of money. But the quote was, and I'm very grateful, frankly, there's a guy named Dave Eikenberry who's over at UC Boulder now. And, he said, look, we're going to pay you a little bit of money and basically take, no investment out on you. You're going to spend a little bit of time with us and it's no investment for you. And we're going to see what happens. And it was great. I really found fulfillment in ways that I hadn't found in my first 10 years of my career.
Yeah, and you were voted top professor in your Master's in Finance graduate program, so you clearly were passionate about it, and you had the energy going into the classroom.
Yep.
So tell me, you were there for a good run. Was it you ended up starting an investment banking academy?
Yeah, in 2012 I launched. Well, really 2011 I launched.
Why not a hedge fund academy or a trading or an investor academy?
To be honest with you, what I could get the school to do was investment banking. We had some very influential board members, trustee members for the College of Business who were part of a very successful investment bank who really wanted to have more graduates be prepared for higher paying jobs. That was the motivation. And so they said, like ours, and it was banking. And given what the irony is, of course, I thought I was not good at my job at M&A. Like I was learning, kind of on the fly, so now I was going to run this big program to train, for 4 years, we placed everybody into an investment bank on Wall Street for the 4 years that I built and ran that program.
Wow.
But we were starting from nobody, I say one firm was coming. I said 1 to 2 firms. That's not fair. 1 to 2 firms were actively, routinely coming to University of Illinois to recruit. And my job was to get it to be 15 firms. And so, and to make sure that the firms knew that talent that I talked about, that randomly distributed talent, existed at the University of Illinois. And I just had to, bring the two together and let things go from there.
Interesting. One of the most famous users in Wall Street Oasis history is called Illini Programmer. He's an alum. I can't say who he is, obviously. He was.
Well, hopefully, I know him.
You might. I don't think he might have graduated before you were there, maybe, or close. But he didn't do banking. Did trading. So maybe you probably do know him. So you're there for a good 7 years, running this. Everything's great. And then what happens that Point72 picks up their head and they say, we need somebody to do this, or you came across it? How did you hear about this? Was it always the professional development role, or initially when you started at Point72?
So what had happened was I had actually had an alumni from Illinois, I think, connect with somebody at Point72, because I think Point72 was thinking about a developmental program for undergraduates for the first time. And so what ended up happening was I was connected to the former head of our global equities team at the firm, who flew down to Champaign-Urbana in a prop plane into the cornfield and provided us with a great lecture to our Investment Banking Academy group. And at the end of that, he said, do you have 5 minutes? And we talked for about an hour over, the Jimmy John sandwiches in the middle of a conference room. And by the end, we had kind of come to an understanding that maybe I could be helpful on a consulting basis, at least, to think about how this program could work for high potential undergraduates to become direct long-short analysts at the firm after a brief training period.
It's so interesting because we've seen a lot of firms on the buy side kind of start opening up analyst programs. It sounds like Point72 was a little bit ahead of the curve. I think it was a little bit more rare in 14. Was it 14?
We were the first ones to do it, I think, in 2014. And we placed over 100 people now at the firm, since we started the program, with a retention rate in the 80% after 5 years.
That's it. So you're saying out of people who start in the program, 80% are still with you 5 years later?
Well, of the total population, we still have 80% of the people. So, not everybody started 5 years ago. That's
right.
Not fair.
That's great. That's really good. So I guess it's probably very competitive. Well, before we even get into that, before we get into all the dynamics, I kind of want to just finish your story a little bit, in a sense of putting a bow on it, and then I definitely want to jump into a little more information about everything you're doing there. So when you kind of made that decision, it sounds like it was the consultation, kind of, they were trying to pull you away. What kind of convinced you to go full time eventually? Was it just exciting? You got excited about it?
I had the chance to build the training program of my dreams at a firm that was going to resource me to create it exactly how I would imagine it. And I can't think of a more compelling opportunity than to have someone like Steve Cohen, decide that this is what he wants to build and really share the personal development mission that I have by opening his firm to, let's be honest, it was an experiment. It was a project. Who knew if I was, I was, at this point, I'd been a professor for 7 years and out of the industry. Who knew if I was going to be successful? And he was willing to take that shot, that initiative.
Do you think he was willing to take that shot because they had seen some young traders, they didn't think it was an age thing that was determining success or not?
That's a good question. I don't know the answer to that. So it's hard for me to speculate on. But
you felt like you could train it because you had done it.
I did.
Yeah.
I absolutely felt convicted that I could take the Investment Banking Academy and the courses I was teaching in investing, because the university had already started to say, what can you do for us on the buy side? I think they'd come to that place. And so it was kind of at the same time. And I felt strongly that if you have great talent, the only question is how to turn that into someone productive quickly. And so, but it's really dependent upon the people, people's willingness and desire to become great investors, I think. It's kind of like great soup or great food. Like if you have great ingredients, you can kind of make a mistake in the recipe a little bit and still turn out with a great, a great product.
So looking
So I
back,
really, yeah.
sorry, go ahead.
Mhm.
So looking back, just do you feel like looking back over your career, I mean, you've now been kind of in the, the teaching space now, and the at least, well, you're kind of a direct, you're more of a director, so you're not like in the classroom anymore. It sounds like, or are you?
I am totally still.
You're still
I
doing
would
it.
never. I
You're not
know.
going to
Yeah,
let
I
go of
don't do
that.
it.
Okay.
I'm not going to let it completely go. You're right. I don't do it like I used to, and I miss it. I think it's a lot of fun, and I still learn every time I'm there. So to be totally away from it, I think would actually not. It would make me less productive
Okay.
in the long
Fair.
run.
And so looking back on your career to date, the 10 years in hedge funds and then now on kind of the teaching, any thoughts on like the transitions you made? Do you feel like, oh, I wish I'd gone earlier, I could have made, or do you feel like, hey, should have stayed a few more years? What are your
Uh huh.
thoughts, looking back on it?
Um, yeah, like I think I had to learn what I'm teaching, and so I think that it was a good investment of my time. I'm not going to say I enjoyed most of it because I didn't. For me, again, not sure I did. But it was necessary. I still really enjoy investing. So I am so grateful to have had that time to learn it. Um, I could I have accelerated it by a couple of years here and there, perhaps, maybe on the teaching side, but I don't regret. I think a couple times in my life I've really tried to make decisions that were risky for the point that I wanted to be happy, and I was willing to take the risk because I figured success would come if I was happy in what I was doing, and that doesn't just apply to my career, by the way, but like it is. So I've kind of always been a believer that, if you can be true to yourself and your best self, if you can bring your best self to work in what you're doing, you're going to have the highest probability of success. And so I don't regret, taking the time and looking back and saying what I wish I could do differently, because I'm pretty happy where I am, with what we've done
Sounds
today.
exciting. Yeah, it sounds like you are. So that's good. Um, I think we can all aspire to be doing something we love. I feel just as fortunate to be doing Wall Street Oasis. It's like a dream.
I was gonna
So
say you must, yeah.
even with my
Like I
fake
think I'm
office
looking at
behind
someone there.
me, yeah. So
Uh-huh.
so I think now that we've kind of gone through that, I really want to spend some time just some overarching questions, more about kind of trends and what you've seen, and just to get your perspective on things. So I've noticed just over the last 5, 6, 7 years, even just quant, right? Like you need the technical skills and, learn Python and learn machine learning is a big, buzzword now, AI, all that stuff. Um,
What's that? Yeah.
yeah, is the academy is the academy only focused on fundamentals? And talk a little bit about who you're looking for and what the main focus is. Like, are you teaching any of that stuff, or is it mostly more like a fundamental long short type of curriculum?
I think the analysts of today have to be smart with data. And we do have some analysts that we do train for the purpose of being data scientists, actually a discretionary data scientist on teams. We actually have a data science sort of academy sleeve. I think that but every academy person has a fair amount of training on the data side. And when I say on the data side, I'm not saying we teach them 10,000 hours of Python, because I don't think that's efficient or productive. But I do think that if you put two people together in a room from the academy and you gave them a piece of data, structured or unstructured, they would look at it in interesting and probably different ways. And I think that is the important and crucial monetization piece that we try to teach in the academy that I don't think anybody can learn in school. I think you need repetitions, or what we call reps, right? I think you need reps on how to use structure cut data in interesting ways, and I think that's the intersection for us, in the academy between data and fundamentals. I mean, yes, we teach fundamentals, of
How much
course,
of what
but
you're teaching is like a pure technical skills of like being able to manipulate clean data and data analytics, in quotes, versus knowing how to think creatively around the data? Like, because I would think that you could teach the technical skills probably pretty easily in terms of like tools and Python, whatever it is, Pythons are coding languages, but it might be harder to teach somebody's creativity or a different way to look at the data that might unlock some alpha.
so we actually We actually, you're right, but that is actually the part that we do teach,
You do? Cool.
and so the firm has a tremendous amount of data market intelligence resource, and people in that team, do an amazing job with the amount of resource and productivity that they have with the tools. But on top of that, of course, they need to partner with people who can ask good questions and take the data and take it a step further, and then a step further, and a step, and that's really the repetition that we try to teach.
So the people who are interested in that side, would they be applying through the academy still?
They would be applying if they want to. It's a good question. If you want to be really focused on product and on scalable product, you would apply to the MI data lead of the firm. Yeah. Otherwise, it would be if you want to be a long short analyst or work on a discretionary team, you would apply to the academy.
So let's talk about the academy in terms of the different programs you offer. There's the summer internship. There's the two other programs. It's called the associate program, the full-time associate, and the experienced associate. Tell me a little bit about the differences of the two and the internship, and if you're able to share out of the internship, what are the offer rates looking like typically year over year?
Sure. So the Point72 Academy was sort of the initial one was really geared at undergraduates. Maybe I'll take you through a brief history to sort of get to all the, get to all those sort of the questions. The Point72 Academy offering started in 2015 with largely as an undergraduate focus. At that time, I think we had 400 applicants and we had 10 seats, and our graduation rate at that point, to be honest, was I think 70%. So it was, to me, that's not great. Our overall, today that we are on an average of 91% as we have evolved who we've hired and how we train people. I think, we have 16,000 applications this year.
When you call it graduation, you mean they've gone through the 10-month program and they don't drop out, or they're given a full-time offer after or something? Is that what you mean by graduate?
Right. So yeah, I'll start. I'll back up. So the regular program, or the Point72 Academy, is a 10-month program where we really spend the first 10 weeks in an MBA boot camp, if you will, like learning the skills, the disaggregated skills, and then necessary to be successful literally on the job. And then we spend the next 4 or 5 months combining those skills in a way that gives people repetitions around what it's like to be an investor on a team. And so
a lot of paper trading, and stuff then, or no?
There is a mock section, but no, obviously we do not, we would never put anybody like that in front of anything beyond that.
Yeah.
So we really teach a lot of fundamental skills, compliance, how to handle data, how to host an interview, how to develop a thesis, really every aspect of being a great, and compliant investor. And then, we just give them repetition after repetition until we feel they're ready to do some rotations on teams. And then they complete a couple of rotations where we hope there's a mutual match, and then placement of the associate onto an promoted to analyst role.
Yep.
So in this case, there is a promotion because there is a distinct difference in responsibility and role. The Experienced Academy program is for those who have done something before.
Yeah, before you go to the experience, so the full-time, it's people that have just graduated. Like, does it always start in, I don't know, September or July, August? Is it ongoing, just a rolling 10-month program?
We have 3 intake dates per year around the world, and it's not, so they're a blend. And so you could be, an undergraduate, you could be an MBA graduate, you could be, we really like to hire veterans who have come back and gotten a graduate degree. So they may not have civilian work experience. Or they may come from banking or be a doctor or we've hired people from the White House. We really, as long as they haven't had a lot, really any buy-side experience, we consider them to be a good candidate for the academy, or we can then teach them the Point72 way of investing.
Got it. Okay. And then, so that's basically a non-guaranteed offer, but it's an offer for 10 months, almost a year. They get almost a year to work with you and go through that program. It's considered like an educational stuff. Where are they paying you? Are you guys paying them? How is it How is that?
Oh, it is a paid opportunity. It is highly competitive. You can compare it to any high paying Wall Street job in the world.
So are you guys just losing money? Like you're just funding it basically just because it's a good pool of talent for you guys because they're not actually putting any money to work, right?
That's so interesting you say that. I think it's a wonderful investment.
Well,
But
no,
I consider it to be an
I'm
investment.
saying direct, like those years that you're training them, they're obviously not putting any money to work. They're not making any alpha for you guys, but obviously, yes, it's if you're
It's a
doing it,
J curve.
yeah. So the thought process is we're going to invest heavily here in this program and get a bunch of great investors under our umbrella, right? So,
Well, we have a 91%. As I said, 91% placement rate. Like let's not mince words about graduation versus place. Like 91% of the people who enter the program to date in 6 years now that we've had it 2021, so 6 years. Yeah, we've had 91% placement. Not everybody chooses to go into long short from that. Almost everybody does, but for example, we have a ventures group, and some people have chosen to go to the ventures team or the macro team. Or, we have never placed anybody in Cubist or the super quantitative, sides of it because they really look for a slightly different kind of candidate. And as I said before, our retention rate, I feel very, very, fortunate about our retention rate, but I think the firm has worked really hard to solidify the fact that, we are the top development brand in the hedge fund space, and we will continue to work with analysts to develop them. And I think that's compelling.
No, for sure. Then, 91% is a great offer rate. So tell me a little bit about just who you look for, how to be competitive for this, because I think that's the program that most of the listeners are going to be interested in.
I hope they are.
How do they stand out in these applications? What do you force them to do? Is this a lot of a higher view stuff that they're used to at the big banks? Are you doing a bunch of math modeling tests? What are they forced to do?
Yeah, no, look, we think this opportunity is unique, still in the industry, but our process probably sounds similar to a lot of the Wall Street processes out there. And so, because we do have, over 16,000 applications, this year is over 16,000, unfortunately, and I say unfortunately, because I can respect the fact that the higher review process is people roll their eyes at that a little bit. I think we try to, do what we can about, we understand, like, I'll say this directly to listeners, like I understand the higher review process cannot always bring forth personality, and that personality in terms of desired of wanting to be an investor, there are things about you that are unique and special that I care about. And I understand that's not always easy to convey in a higher review. And so that's not the intention. The intention is to truly find, to answer your question, people who want to do this, people who know they love it, and even talk about, how do I know I love this if I've never done it? Which I would think is a good question, right? Even for those, like, I didn't have any money to invest. Even if I had known I wanted to be an investor, it's not like I could have opened up an account and traded. And I would make the argument that, a paper account does not feel the same when you're losing money as a real account. And you're laughing because I'm right. So, I think, depending on who you are and what you want. So if you want to go into market intelligence, there's a track for you. If you're somebody who's new to finance, we're going to talk about what we look for from our, fundamental academy. The Experienced Academy, again, is the fundamental academy, but for those who have experience, so it's a little bit more advanced or accelerated. But we're going to, at that, there will be a track for them, so that people who have been in banking for, a year or two or whatnot.
Can I stop there and talk a little bit about that transition? Because we have a lot of bankers listening too, who may be interested in buy side. So like, is there, traditionally, it's very common for hedge funds to pull from the investment banking ranks. So it's a little bit, obviously you guys were first to kind of start pulling from the straight from out of undergrad and putting them through this more rigorous, longer time frame. But are you telling me that you're recruiting bankers and they're not trading within 3 months? Like they're not actually doing anything? They're just going through this training for that long?
That's right. Well, it's for 8 months. So they do go through an 8-month training program. So why do we do this?
Yeah.
We have found over time that banking has changed. I have found that banking has changed. I trained for banking. I trained undergraduates for banking for years. And I think these days, more than ever, it's become more transactional. It's become more templated. And I think the investing role so I think there's been like this sort of this gradual and maybe not so gradual divide and gap that's occurred between what it takes to be a successful long short analyst and what it takes to be a successful analyst at an investment bank. And this notion of monetization and being able to convert your work into actionable ideas, I think it's unfair to assume that somebody who's been in a banking position can just kind of wake up and generate stock ideas. And I think that's something that should be taken seriously and respected. There is a transition that's necessary. I mean, how do you know how to short a stock based on working on an M&A deal or a pitch book? Like I don't understand. And I think, as I said, we are the #1 development firm, and it is because of the insights we've generated over the years that we understand like you need a minute to kind of understand to understand like what makes a good short opportunity, even out of a bank.
Who's number 2?
I haven't found number 2. You let me know who number 2 is.
No, when I say who's number, who comes close in terms of the number of months that you guys are training experienced analysts, or do all of them kind of start? Is it more of an apprenticeship model where they're giving them just not a lot of P&L? That's
my understanding. I wouldn't know. And certainly when I worked at other firms, now this is a long time ago, that wasn't around.
Do you feel like other hedge funds, large hedge funds, are following this model and starting to do more straight out undergrad and longer training programs for analysts, or no?
I think that's something that I have heard is coming about. And I think that's good for the industry. I think it's good for the industry to have more opportunities for young people. As I said before, talent is randomly distributed, and I would love for young people to have more opportunities as they come out of college or into the working world. And we can't hire everybody, and I think it's great. I welcome that. And I think we should all kind of make sure that we do I think we need to do a better job of really explaining what this industry is and not making assumptions about people being able to jump into investing without proper understanding really of what it means to be a great investor.
Let's talk a little bit now about the summer internship and offer rates. The summer internship typically for undergraduates, kind of I assume in their junior summer or something like that, and you give an offer rate as well on that?
Yeah. So we also have, as I said before, focused on MBA. We do focus a little bit on MBA, so the MBA internship as well. But it is meant for school year. Typically, we are this year hosting other opportunities, throughout the school year. Given that it's remote, it's a little bit easier to kind of provide other options as well. But and happy to direct people to Point72's website on the career opportunities there.
Is the summer internship, are they like graduating into the program? So they go from like summer internship to a 10-month training, or is it, if they do the summer internship, it's more expedited, or how does that work?
Yeah, well, we source a lot of our full-time program members, particularly out of undergrad, directly from the internship. So they would graduate, and then the following year they would, after the 10-week internship, they would join the firm full-time and we have multiple start dates, as I said. So there's not like, this one start date where if you graduate, it's not like a machine. It's really flexible because, people graduate at different times of the year. And frankly, if I'm honest, the PMs need hiring at more than one time a year. So, it works for both of us. Our offer rates vary. I would say it tends to be from the mid-50s to the low 80% in different years. Again, we've done this for 6 years. So it does vary. I want to make this really clear. We never overhire for our intern program. Every time we have an intern, it is my hope, and frankly, my expectation that they will receive a full-time offer. And so, but I think people should use the internship for what I think it was meant to be. And I wouldn't know because internships didn't exist in back in my day, which is that sometimes I think people figure out this is not what they want to do. And I have worked with many undergraduates who are honest with me about that by the end of the summer to help place them elsewhere. And I think a good employer should really be a good partner to their employee and make sure that they're on the right career path that's right for them, even if it's not here. We have also placed people out of the internship into other roles in the firm because we really do want to retain everybody. And as I said, I have never overhired.
Fair. So I think in terms of what else am I missing? What else should the listeners know about just the program itself? I mean, it sounds fairly intense. Is it, crazy hours during the training? Is it hours like, is it ramped where training's more like 60 hours a week and then they get on when they actually become a full-time analyst, they're doing more like 80 and stressing over the markets, or what's the ramp up look like?
Well, fire drills are interesting, I think, and the fire drill method, like mentality, isn't the same thing here, right? That's a big difference. Is yes, it's a lot of work, and if you love what this is, it doesn't feel like work. And if I've built a good community around the class, then it should feel fun. I'll take your question in two parts. The first part, the 10-week MBA, mini MBA, it's a lot of work the way school can be a lot of work for hard classes. Because that's really what it is. It is assignments, it is homework, it is tests. Like everybody kind of, if you've ever heard about our infamous accounting test, like, yes, I have an accounting test. Yes, you need to pass it. Almost everybody does. And frankly, if you don't, it probably, I mean, in my experience, 100% of the time, it's because you don't want to do it. It's not because you can't do it. I think the instructors that we have are phenomenal. They're some of the best in the world. And so, we, again, with a 9%, rate that hasn't that hasn't placed at the firm, you can imagine like about 1 out of every 10 people decide, yeah, maybe I really don't like this. And most of the time they have an intern with us, which is a big tell to that. So, after the 10 weeks, when you start to really get into coverage and companies and pitching and events, like you're going to learn what a fire drill is, which looks a lot like earnings. Occasionally you have a deal announced on one of your names. So, that can be a fire drill, but it is not the same, there goes your weekend at 5 o'clock on a Friday. That doesn't happen here. I need people to sleep, actually. I need people to have a quiet time. We need to have events with people. We have an incredible community at Point72 with affinity groups and with, community matters. And it is very important to us that people bring their best selves to work every day so that, yeah, we get the most out of you. We don't just do this to be nice. We do this because we want you to be productive.
What would you say to people who are applying who are just nervous about just the overall trajectory of the industry overall? As hedge funds left and right have been falling by the wayside. What would you say to those people? Would you say, oh, don't worry about it, it's because those hedge funds are terrible, or would you say there is a shift of more passive investment versus active management?
Well, that's a good question. I would never say anything like, don't worry. I think if it's a worry, it's legitimate. I think we should talk about why it could be a worry. It could be a worry because, ever since decimalization happened in the market, markets have become more efficient. It's a worry because there's a lot of passive money out there. A couple of responses to that I have are, number one, you want to be at a firm that invests in you no matter what, and that invests in itself to make sure that it stays on top over time. And Point72 has a track record of success. And whether it's at our firm or a different firm, any advice I would give to anybody who wants to be an investor is be an investor. Just be a really good one. I think there are still people who earn great returns in this industry, but it is harder than it used to be. And so you need the training to be great. There are more professionals in the market than there used to be. And so you need to find a firm that invests in you, and frankly, find a mentor that invests in you. I'm sure so many of your listeners have, thought about mentors in their careers to kind of get where they are. And that shouldn't stop in college or in your first job. Like, we have mentorship programs at Point72 because I respect the fact that you need a community. This is a tough job, and you need a community to be successful. And so my response is, the market is tougher. You have to be better than you used to have. I think, I don't know how I would do today. It went back when I was there, 15 years ago. But I think it's my burden to train people to be successful. And I think our firm has been successful and maintained that. But I would say to our to your young, future investors out there, don't give up on that dream. If that's what you want to do, just make sure you find the firm that's willing to invest in you. And as I said, invest in itself so that, it doesn't fall by the wayside and become a victim. Steve Cohen always says, you have to change or die. And I think that's true. And I think he's shown in our firm that he's continued to do that as one example. But, there are other examples too. This is not meant to just sell ourselves. Like, I'd say that to anybody.
Yeah. Fair. So, Jaimi, before we call it, I've kept you for much longer than expected because it was an interesting kind of dive into. I don't know much about this space, so it's more educational for myself as well. So, anything else before we call it? Any other final words of wisdom or anything you want to leave the listeners with?
Well, I hope that, I think that if you have an interest in this industry, then we owe it to you to educate you on what this industry, what the long short hedge fund industry is. And if you're interested in that, I hope that they would take advantage of the links that you're going to post about our firm or about other firms, and that the education is there for you if you want it. And, we invite, smart, hardworking, talented people from everywhere to consider it.
One last thing I forgot to ask you. Thank you for the final words, but except you said 16,000 people apply. So I want to let people know it's very competitive. So around how big is the class for this upcoming year, or for let's say for that 16,000 pool? How many people would you?
We'll probably hire 40 to 50, but we will also put people into, the firm is, I'm going to get this number wrong. It's about 1,500 at this point. So we do, take some of this pool and have them consider for other roles as well. But yes, it is competitive.
Mm-hmm, for sure. Okay. Well, thank you so much, Jaimi, for taking all this time and sharing your story and sharing the insight into the programs over there.
You're welcome. And I was just told it was 1,600. So I already, we're growing faster than I realized. But thank you so much.
That's good.
I
Thanks
really
so much.
appreciate the time.
And thanks to you, my listeners at Wall Street Oasis. If you have any suggestions whatsoever, please don't hesitate to send them my way, Patrick at wallstreetoasis.com. Until next time.